Well, it was a fourth straight week of losses on Wall Street last week as the S&P 500 fell over 10% from its record highs set in mid-February into technical correction territory amid continuing trade policy uncertainty, which resulted in significant haven demand, propelling gold north of $3,000 an ounce for the first time ever, as both the foreign exchange and fixed income spaces continued to trade in relatively or very choppy fashion. This week, a central bank bonanza lies ahead, either 5 or 6 policy decisions, depending on who you ask, as well as a busy data docket up ahead, plus, of course, the ever-looming and lingering threat of Trump dropping some tape bombs into the mix as well. Plenty for us to discuss on the trade-off this week. Without further ado, let's crack on with the show. So it was an intriguing week for the financial markets last week, and I'm not sure another week of fun and merriment awaits us all in the next 5 days or so. Joining us, as always, to try and make sense of everything that's going on is my good friend Ryan Littlestone from Forex Live and Forex Analytics. And before he says anything, yes, I know it looks like I'm wearing a tea cloth as a shirt today.
Tea cloth, tablecloth, you can whip it out and get some sandwiches out on it, and we'll have a nice picnic.
Deary me. I wish we could. I think having a picnic would be infinitely more fun than trying to deal with whatever nonsense the markets are throwing at us this week. I mean, what was it last week? We had US trade policy towards Canada changing twice in the space of 8 hours, 200% tariffs being lobbed on champagne and all the rest of it. You just don't know whether you're coming or going these days, do you?
No, and it's a sign of the times, because I'm getting a little bit worried. We haven't heard from Trump this morning in the US time zone as we're filming this. I just had to check out his schedule and check his Truth platform just to see what's going on, whether he's having a lay-in or not. But it's been quiet on the Trump front so far.
It has, but now you've said that, I'm sure we'll get an absolute deluge of social media posts as soon as we start talking. So thanks for tempting fate on that one, mate. But nonetheless, we do have a very busy week ahead. So let's get into the meat of things in Topical Thunder. Right, let's hope Trump can stay quiet for the next half an hour or so we can get through the show. Speaking of Trump, who has literally just posted on Truth Social. Thank you for that, mate. Well done. We are hopefully, for at least an hour and a half on Wednesday night, going to get a bit of a break from the orange man in the Oval Office and all of the tariff nonsense, with the FOMC taking centre stage for their March policy decision. I think it's pretty much certain that the committee will maintain the target range for the Fed funds rate at between 4.25% and 4.5% in what you'd expect to be a unanimous vote among committee members. And I think it's also quite likely that the statement is pretty much a carbon copy of that issued after the January meeting, noting that risks to the dual mandate are roughly in balance, stressing a data-dependent approach and also flagging the uncertainty around the outlook. We might see a modestly more pessimistic tone around economic growth, but I don't think we're going to see any significant revisions to that policy statement, all told. As a result, focus over the FOMC decision will fall on a couple of things: the updated summary of economic projections and what Chair Powell has to say at his post-meeting press conference. In terms of that SEP, it's obviously pretty tough for anyone to have much conviction about what's going to happen to the economy in this environment, whether it be myself or Ryan sat here on the trade-off, or one of the 19 members of the FOMC sat around their large boardroom table. As a result of that, I think we're going to see some huge dispersion around these forecasts, but you would say that it boils down to, when you've got tariffs and all of this uncertainty, it should result in near-term inflation expectations being nudged a little bit higher and near-term growth expectations being nudged a little bit lower. In terms of what that means for the dot plot, I think the simple answer is not a lot. The dots that were released back in December pointed to 50 basis points of cuts in 2025 and 2026 as the median expectation. And I reckon that probably stays the same. Just mathematically, you'd need 5 of the participants who are at the 2025 median to move their dot lower to become 3 cuts as the median. And I think that's pretty tough to envisage in this sort of environment. A little bit of chatter around whether the longer run dot is moved higher to imply a higher neutral rate. if it is, I don't think it's going to be a huge concern for market participants. I mean, we're talking about a 12 basis point move, which is hardly worth getting out of bed for. What will be worth getting out of bed for, though, is the press conference. Chair Powell probably going to stick to his recent script. We heard from him right before the blackout period got underway. He should just re-emphasize that the Fed are not in a hurry to deliver any rate cuts, that the economy remains in a good place despite ongoing uncertainty, and that the path back to 2% inflation will be a bumpy one. It will be interesting if he has anything to say on quantitative tightening. There is some chatter that the Fed may pause that as soon as May amid the debt ceiling shenanigans going on in the United States. What will not be interesting is any journo who wastes their question talking about politics, because clearly that is not something that Powell will answer. I think overall, though, unlikely to be a game changer this week's FOMC. It should just reinforce that the bar for cuts in the first half of the year is a pretty high one, that the Fed are ready to act and will continue to lower the Fed funds rate when it becomes appropriate to do so. But maybe it's just a modicum of normality amid the tumultuous trade that's going on elsewhere to sit there and listen to the dulcet tones of Mr. Powell for an hour or so.
Yeah, you say about getting out of bed. I don't know what you'll be doing in bed at 6 o'clock in the evening, that you'd have to get out for this meeting, but another half day, no doubt, for you on a Wednesday. But coming back to the Fed, yeah, this is one of those meetings where you probably know it's going to be a boring one, but you just hope that we get something that gets markets moving. I think on the projections, the most we're going to see is perhaps a little bit of a squeezing closer together of those dots, if at all. Some of the outliers who are looking for either more cuts or even keeping rates even higher, just coming down to that medium a bit more. But like you said, I don't expect much, and I fully agree with your comments on inflation and GDP overall, both or GDP coming down a little bit, inflation maybe going up a little bit. So yeah, the only thing I would be looking for this meeting is whether Powell wants to address this market mood that it's in at the moment, getting a little bit bearish on the US economy, even when we get data that suggests otherwise. Yeah, we've had a few little minor data points wobbling. The consumer sentiment stuff that we've seen previously last couple of weeks coming in much softer, including the Michigan numbers on Friday. And retail sales have just been out hour and a half ago odd, and they showed an improvement. Missed expectations, but the core sales, the control group, came in a whopping 1% versus 0.3, turning around a negative 0.8%. So, there's no worries anywhere, but the market is in this mood at the moment where it almost wants the US economy to weaken so it can push its agenda and take yields lower and the dollar lower. But that's about the only thing I'll be looking for, perhaps Powell to push back against a bit.
Yeah, I'm glad you mentioned some of that data, because I sort of want to take the other side of that. I agree with you on the University of Michigan number. I mean, it's complete nonsense, to be honest with you. The survey size is tiny, and when you dig into the data, it basically shows that sentiment among Republican voters is holding up and it's tumbling among Democrat voters. I mean, the bloke who you didn't vote for is in the Oval Office. Are you going to be confident? Probably not. I don't need a survey to tell me that. I could have told you that just by asking a random man in the street. The one thing I would say, though, is, and you mentioned that retail sales data, we got a couple of other sort of second-tier US data points this week. Housing starts, building permits, industrial production are all due tomorrow on Tuesday. What I would say, though, is that most of this is February data. Actually, all of it's February data, and pretty much all of it is from before this kind of to and fro and tit for tat tariff nonsense started getting thrown around. So I think what the market's doing is actually looking at the incoherence with which policy is being made, and also looking at some of the sentiment data and saying, if this degree of uncertainty persists and we extrapolate that over the next, 6 to 9 months, plus you've got the Treasury Secretary and the Commerce Secretary both out on TV 3 times a day, rolling the pitch for an economic slowdown, talking about this idea of short-term pain, long-term gain, not being worried about, the market coming lower in terms of the equity market, of course. It is very, very tough to sit there in that environment and say, you know what, there's no worries about the US economy whatsoever. So, I understand very much the market's mood at the moment. Personally, I don't think that's something that Powell is going to try and resolve, because without putting too fine a point, it's not him who's caused it. He is but a passenger in this situation. Anyway, we can talk about Powell all day. We probably shouldn't, because there's it's a bit of a central bank bonanza this week, to be honest, isn't it?
Yeah, absolutely. And we've got six central banks, not the five you thought we had originally before we started the show. I apologise to all our Mexican viewers who forgot about your central bank meeting this week. Usually it's the Kiwis
who's distraught.
Yeah, usually it's the Kiwis writing in letters of complaint, but now you're going to get the Mexicans writing in complaint letters. So I'm just going to run them all over these other central banks. I know Mike's going to cover the BOE, so I'm going to have a quick look at the rest of them. So we get the Bank of Japan meeting on Wednesday. An unchanged decision is expected. We've had a few of those early Shunto wage negotiation announcements out so far, and what they've shown is that agreements are coming in slightly less than what's being demanded, although they are still higher than they were last year. So we're having a little miss on expectations, but higher wage negotiations than last time. That was just some of the first round negotiations. So we've got a couple more rounds to go before we get the final numbers. We also had CPI data, and on that front, the CPI is coming really strongly in January. It's up at 4% in the headline, and the core's up at 3.2%. As I say, those were January numbers. We've already had the February Tokyo CPI numbers, which are very important. It's the biggest region in Japan, obviously, and they come in ahead of the national numbers. Those show a bit of a pullback. We've had headline CPI coming down to 2.9% from 3.4, and the core measure coming in at 2.2 from 2.5. So there's been a little bit of softening there. But I think all these are just reasons for the BOJ to remain cautious this meeting and then see how these final wage deals go, the fiscal year end pans out. And then we have another meeting anyway, 6 weeks' time in April. So they've got enough time to let all this develop and see what the lay of the land is before they decide to move again or think about moving again. On Thursday, we get the SMB. They're looking to cut another 25 pips to 0.25%. That's getting them very, very close to zero. Now, these guys only have quarterly meetings. You only get 4 of these a year. Again, with CPI, they're down to 0.3%, which is down at the lowest level since April 2021. They might not be done yet in that case, and could they be the first central bank to get themselves back to zero? We then get Sweden's Riksbank. They're due to pause at 2.25%, one of the banks who have already gone into pause mode. They indicated this is where they'd like rates to get to in a December meeting. They cut in January, and so here they are looking to stay at this level moving forward. And then Mexico looking to cut 50 basis points to 9%, which one might think might put further pressure on the big carry trade that we were talking about last year. But given that dollar MEX has just recently broken the 20 level, I think that shows perhaps that the carry trade isn't what it used to be. It's been reduced a great deal, and more so we're trading the geopolitics. But I want to quickly jump back to the Bank of Japan and look at dollar yen, which I think I spoke about it last week. We had a big level down at 147, and we broke it briefly down to 146.50, but then we've bounced back above and held it again. And this is something I'm going to be looking for across the Fed and the Bank of Japan. If the Fed is in any way dovish or bearish about the economy, if the Bank of Japan indicates some hawkishness there, then if we get another test of that 147 level, but it holds on that, that's going to potentially set up a really strong bottom, and then we might see this trend down that we've seen all year suddenly looking like it's going to reverse.
Indeed. Plenty to digest there. I'm going to make 3 points. I'm going to do them in reverse order. First things first, I thought, I may be wrong on this one, but I was under the impression that the carry trade was already pretty dead, given the level of vol that we've seen over the last 6, 8, 10 weeks. But nonetheless, maybe this will be the final nail in the coffin. Turning to Switzerland, that was the other one I want to talk about. I think the SNB are going to do everything they possibly can to avoid going back into the ZERP or NERP era, which everyone had hoped was long in the past. So I wouldn't be surprised to see their rhetoric shift away from interest rates and more towards more explicit currency intervention as how they manage the economy going forwards, which of course leaves them at risk of running the wrath of President Trump, given that he's trying to engineer a weaker dollar. The last thing that he wants is other people trying to weaken their own currencies. And last but by no means least, on the BOJ, just worth noting, actually, I think that unless I've missed them, which is distinctly possible, we haven't yet had any sources stories ahead of this meeting, at least not over the last week or so, which again just suggests that they're probably not ready to do anything just yet. They haven't really done any of the groundwork to sort of prepare markets for further tightening. But I think, clearly the direction of travel for rates does lead higher. Inflationary pressures are becoming considerably more embedded within the economy now. I guess the big thing is, does Ueda at the press conference, does he sort of explicitly give a ceiling or a target that they want the policy rate to get to? There is a bit of speculation that he might, just to try and get this weakness that we see in JGBs under control just a little bit. But again, do the BOJ really want to handcuff themselves? So I think that's probably the big focus this week from the BOJ, not do they hike or do they not hike. It's more a question of, do they tell us how much further they're going to go?
Yeah, and they probably won't, because they never like to. Yeah, they don't like to set themselves anything that they can be pulled up on later. So yeah, they'll keep their cards close to their chest, no doubt.
Indeed they will. Right, well, with that all out of the way, let's go down to Threadneedle Street. Joy of joys, the clown show that is the Bank of England.
Why'd you bother? If you hate it that much, why'd you bother?
Well, we are called the Trade-off UK, so I do feel like we should probably spend a little bit of time talking about our home market. The MPC, they're set to hold bank rates steady at 4.5% at the conclusion of the March meeting. That would come obviously after the third cut of the cycle was delivered back in February, and they should largely leave the statement unchanged, reiterating that there will be a gradual and careful approach to further policy easing, that policy must remain restrictive for sufficiently long in order to bear down on the risks of inflation persistence, and also reaffirming that they'll continue to take a meeting by meeting approach to policy going forwards. The vote split, though, is going to be very, very interesting. Personally, my gut feeling is that they go 8-1 in favour of a standing firm, so 8 for holding rates steady, and just external member Dingra dissenting in favour of probably a 25 basis point rate cut. That said, a split of 7-2 or 6-3 is distinctly possible. External member Alan Taylor has been pretty dovish in his recent appearances. And then, of course, you've got the wild card of external member Catherine Mann, who all of 2024 was a hawk and then voted for a 50 basis point rate cut at the February meeting. There is also the question, of course, as to whether any of those dissent in favour of a 50 basis point cut as opposed to dissenting in favour of a 25 basis point cut. I think the key, though, is that none of the internal members of the MPC are likely to be pushing for further policy easing at this moment in time. So Governor Bailey, his 3 deputies, and the chief economist Hugh Pill, they should all vote for bank rate to be held steady at 4.5%. So I don't think this is going to be a huge game changer for the pound. Maybe a bit of knee-jerk vol on the vote split, if that is a little bit more dovish than the markets are expecting, because we've only got about 50 basis points of cuts in the curve by the end of the year, with the next cut not fully discounted until the June meeting, which feels a little bit dovish for me, because I think they're probably still going to go quarterly in terms of those rate cuts, in line with the publication of the updated monetary policy report, which would leave May as the most likely date for the next rate reduction. But I did just want to flag that we had some pretty disappointing figures out of the UK on Friday last week. GDP contracting by 0.1% on a month-on-month basis in January. And I think that's just a useful reminder that actually, despite some of the optimism, I guess you could say, that has been permeating the markets recently, certainly with the pound having rallied to its best levels of the year, just shy of 130 in recent weeks, although obviously there's a chunk of dollar weakness in that. I think the GDP data was a bit of a useful reminder that it is still a stagflationary backdrop here in the UK. We are dealing with CPI that's likely to get somewhere near 4% by the back end of the summer, and we're also dealing with economic growth that is at best anemic, if I'm being very, very kind indeed. So I guess the question is when, or indeed if, that will become a little bit more of a drag, and whether we then see sterling begin to underperform some of its G10 peers, even if this bout of dollar weakness persists.
Yeah, here we have a case of the difference between central banks. One side, we've got the Fed, who's got a clear path and we pretty much know what's expected. And then you have the Bank of England, where you probably need to put a blindfold on and throw a load of darts at a board and see if you hit anything. So you're pretty sure with the 8-1, but it might be 7-2 or 6-3. So that's painting yourself into a corner. It's a quote, as we used to say, wide enough to drive a bus through. But I don't disagree with you. You know, we had Man, like you say, voting for a 50. Well, does that mean she votes for a 25 to add up to a 50 at this meeting, or is she done now and needs rates to remain restrictive to combat this sticky inflation? We've got Taylor coming in, who's apparently a dove, as you say. So does he vote for a cut? Does he want to make his mark? I think they probably do hold, but the vote could be anything. I'm pretty good at, like you, of just sort of having a rough idea what it's going to be. This could be anything. I don't think we get a cut, but we also might get a close decision. And there's not much else to say about it, really. Yeah, we've got poor growth and sticky inflation, the same as the Euroland and everywhere else. So what do we do with that? Do they cut on the growth situation, or do they keep restrictive on the inflation situation? It's all down to Bailey, and I'm putting a ball in his court.
Oh, God help us. The one thing I would say on Catherine Mann, just before we move on, excuse me, and this could age terribly, but I would be very, very surprised if she went dissented for a 25 basis point cut. And the reason I say that is because she has made a couple of speeches since the February MPC, where she was basically saying that she voted for a 50 basis point cut to try and get ahead of what she saw as economic weakness coming through, and also to send a signal about the appropriate level at which bank rates should be. She then went on in that speech to basically slag off the gradualist approach that all of the other people on the MPC have been advocating for the last 18 months. So if she were to then go, oh, actually, I'm suddenly a fan of this gradualism, and go for 25 herself, I think that might be even more of a head scratcher than this massive U-turn that she pulled at the start of the year. But anyway, we will see what happens there, because we need to move on. After the BOE this Thursday, we have another big event here in the UK, which is, of course, the spring statement on Wednesday, the 26th of March.
As per usual, when we get these budgets and spring announcements and everything, we tend to hear what's coming, in the days leading up to it. So there's really usually no surprises by the time we actually get to it. And this time is no different. Now, a lot of the detailed plans that are coming out already isn't really market impactful, not on their own. But what will impact the market is how it interprets and how economists and everyone else interprets everything that's coming as a whole. What they're going to be asking is, will it be too fiscally tight and restrictive for growth, or will there be measures to boost growth? And will the market believe any of it can be achieved anyway? But what I want to touch on here is that it seems Reeves is already facing battles within her own cabinet, members who don't want to cut him back too much on welfare and then raising taxes on top. Now, over half of them are already said to be against some of her plans, which puts a huge amount of pressure on PM Starmer to maybe play peacemaker in the middle. Because while the whole government may be out of their honeymoon period now, he is still running a new government. And this is not the first time that Reeves has caused him a bit of angst with her decisions, even though he's backed her at every point so far. So the bigger concern for me here is not what Reeves' policies are per se, it's the market reaction to her, and whether she's going to keep playing the hardliner or whether she concedes some ground to her colleagues. Now, I would put this moment down as yet another confidence test by the market, similar, albeit on a much smaller scale, to the Truss and Querten saga. And that might be the bigger market moving news than the actual details from the spring statement. So with that in mind, I think we need to pay close attention to euro sterling over this event, because I think if the market takes a dour view of what's coming next week in terms of whether she can achieve it, or if it's too harsh on the UK, we could be seeing this rallying up to 85, if not through it. So this is going to be a big one next week for from a market confidence basis.
It is. You're absolutely right. And I also think that this will probably be the last fiscal event that Rachel Reeves delivers as Chancellor from that dispatch box. The reason I say that is twofold. I think, firstly, it is very clear that although gilts have rallied a bit recently, the yields have come off the wides. I think it's very clear that financial markets have lost confidence in the Chancellor at the moment, given the ructions that we had earlier in the year. Once you have lost that confidence, it is very, very hard to win that back. And I think also, given what is going to need to be done in order to restore fiscal headroom per the OBR's forecasts, the scale of fiscal tightening is huge. And by that, I mean either Rachel Reeves is going to have to stand up and deliver significant real terms spending cuts to pretty much every government department that isn't protected. So that's everything apart from defence and health. Or she's going to have to stand up and announce a ridiculous amount of borrowing, which, I mean, you can't do that given the way that gilts are sat at the moment. You just cannot do that. Or she is going to have to announce tax increases that breach every single one of the manifesto commitments that they made. And of course, remember, this is all coming from someone who committed to holding one fiscal event a year. There shouldn't even be any changes coming on the 26th of March. They should only be coming in the autumn. The only reason they're coming on the 26th of March is because Reeves left herself so little headroom at the October budget, £9 billion, against the new fiscal rules, of course, which meant that even a modicum less growth than the OBR had projected, or even a modicum more spending than the OBR had projected, and your fiscal rules have gone. Of course, yields have gone through the roof. Your headroom has totally fallen apart. So I think the easy option politically is for her to deliver this statement, and then Starmer cuts her loose, maybe after the local elections, because it will go down terribly. Let's be completely honest. There is no way that what Rachel Reeves announces next Wednesday will be greeted with, cheers and people popping bottles of champagne and celebrating. Let's be completely honest. So I think either it's a case of she is unable to restore market confidence, and I think that's pretty likely, or she loses the political confidence of the Prime Minister, in which case she's out anyway. So taxi for Rachel, I guess.
But I would counter that by saying if Starmer's obviously going to see what she's going to give next week, and if he doesn't like it, he's either going to put her up to announce all this stuff and then cut her 2 weeks later. So that could mean that if he doesn't like the look of it, he's going to step in and force her to maybe concede or kick some things back, at least to the autumn when it comes at a proper budget. But, I can't. If she goes out on a limb, and she would potentially be effectively going against his wishes, then that's when she'll be outed. But, it's not looking good either way next week, but we shall see.
No, it's not. The problem is I don't think they can delay things. Just to cover that point off, because if Rachel Reeves stands up and goes, the OBR project that our fiscal headroom is, wafer thin or even completely eradicated, but I'm not going to do anything about it until September. Well, good luck selling that one to the market.
Damn if you do, damn if you don't, then. Isn't it? Yeah, you're making a case why I should be piling a pound shorts at the moment, but the sentiment is that.
Yeah, I think sterling shorts and gilt shorts are going to be a little bit crowded next week, shall we say. Anyway, let's move on. I'm sure we'll talk about that more next week to our plays of the day. I want to talk about the S&P 500 this week. I was banned from talking about this at one stage last year because I was saying the same thing every week. I'm going to say something different this week because not only did the S&P 500 fall more than 10% from the all-time highs that we saw in February last week, entering correction territory, we also traded below the 200-day moving average for the first time since November of 2023. And people who followed us for a while will know that I do not go a bundle on technical analysis, but the 200 200-day moving average is one of, if not the only technical indicator that I actually pay attention to. And as the old saying goes, nothing good ever happens below the 200-day. I remain, in the short term at least, bearish on the US equity market. Clearly, we have policy uncertainty going through the roof. We also have, and there's no sign of that stopping, by the way, we also have earnings and economic growth expectations, which haven't really come lower to the extent that you would expect them to, given the environment that we're now currently operating in. In addition to that, I think we've moved from a market where dips are buying opportunities to actually one where the sort of preferred strategy is becoming to sell the rally. And I think that will remain the case unless and until we see a much more coherent and concrete policy stance from the Trump administration. When we have this degree of choppiness and ever-changing nature of trade policy and tariffs here, then no tariffs, then tariffs again, then it's doubled, then it's taken off again, it makes it absolutely impossible for market participants to be pricing risk. And as a result of that, I think the near-term path of least resistance for the equity market does indeed continue to lead to the downside. I think what's very, very telling is the way that we see intraday gains, and then they tend to be sold into very, very quickly indeed. This is not a market that has much of a desire to rally at this moment in time. Let me caveat that, though, by saying that if, and it's a big if, but if this strategy of short-term gain for long-term pain comes off, if the Trump administration are able to efficiently and effectively reallocate economic resources away from the public sector and towards the private sector, as they are aiming to do so, then the long-term bull case for the US economy and for the US equity market is an incredibly strong one. And at some point, there will be a dip that is a buying opportunity, and that rally will be pretty significant, I would imagine. But that time is not now, and I think for the time being, the bears are likely to remain to retain, I should say, the upper hand. Ryan, we're going into the Treasury space.
We are, but just before we go there, I just want to ask you quickly, because you asked me the other week, do you think that 4,800 is going to be traded?
No.
No, you're still on that bandwagon?
I am still on that bandwagon. I mean, where are we now? 56.50. I don't think there's a Trump put. If there is a Trump put, it's got a very, very low strike price on it. But I don't think we get that low.
Yeah. Okay. No, I'm just checking.
I would say, though, that when I say there will be a dip to be bought, I'm not going to put a price on that. I would say that dip is more contingent on either the Oval Office changing the way they operate, or, and I don't think this will happen yet given the inflation backdrop, but Powell riding to the rescue. I'm not going to sit here and go, oh, we've tested 5,400, that means the market must bounce. The reason why we've declined is because of this incredibly uncertain and volatile and incoherent and maybe even insane way that the government is doing policy. Unless that changes, then it's tough to argue that the path of least resistance doesn't continue to lead to the downside, I think.
Yeah, that's cool. I'm on the same side of you. I don't think we'll see 4,800, and if we do that, that'll probably be my level where I try to dip by anyway. So we shall see. But just moving on, and I'm talking about the 2-year bond market, 2-year notes. I'm looking for a bit of a Fed play with this one. I think it's a bit of an evergreen trade for the foreseeable future anyway, but I'm looking to buy a dip on any sort of Fed undovishness on Wednesday. There's a ton of technical confluence down here around the 103, 102.29 area. There's a lot of moving averages down there. I know like the 200-day moving average. That's way down there as well. And I think that even if you could trade it down to the 102.15s, that will mean yields have really rallied quite a lot. So there's been some big news out of the Fed. But that latter level might be a bit of a pipe dream, though, because still the Fed's aim is to get rates down, get them to a neutral level. And if the economy obliges, then rallies in yields, i.e. dips in price, as I'm looking at here, are going to be potential gifts for trading. So that's what I'm looking at on this one. Nice dip in yields, in 2-year notes to get long.
Yeah, I think I would agree with you on that one actually as well. So there we go. We can end the show on a consensus. Bearish equities, bullish bonds. What an original play that is. In any case, that does bring us to the end of another show. Thank you very much as always to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. Thank you also to our producer Kyriakos for bringing things together as well as always. We're sending him off for a geography lesson in time for next week. So hopefully all the pictures are correct. Hopefully you've enjoyed the show as well. If you have, drop a comment as well. Let us know your thoughts on the markets, anything you're viewing out there, or anything you'd like us to discuss next week. Leave a like on the video as well. And of course, we'll be back with another episode of The Trade-Off this time next week. In the meantime, thanks as always for watching. Goodbye for now.